And so we're in a situation where we put a lot of stress, and we're painting ourselves into a corner. And with estate plans that we do, we see that. We see people painting themselves in this corner, and our goal is to relieve that and to give them an out, give them an exit point so they can have fabulous care and not stress the family out and keep the family together and united. And that's the whole idea behind this. So the question, Todd, what do we usually ask our clients when we get to this point in estate plans, financial plans?
Yeah, I mean it's one of the biggest things when we're doing our financial planning, estate planning, that we see unfinished, unresolved, is not having the long-term care part sewn up. And if you look at the numbers, if you're liquidating IRAs or other assets, which we'll get to, it's going to burn out or ravage through those lifetime savings really quickly. So that's why we're talking today, is so that we can be prepared when these events happen. Like we just seen, 8 out of 10 women will need this and need long-term care at some point. So it's a pretty high percentage chance that you're going to be using this.
So which assets would you cash in first if you didn't have these plans? And obviously it'd be your most liquid assets. It would be your CDs. It would be your brokerage account. It certainly wouldn't be your real estate. It most likely wouldn't be your IRAs because you'd have to pay taxes on that. So it's going to be the most liquid assets. And what we're talking about here today is if you could take a dime, and you could take that dime and take it from your left pocket and put it in your right pocket. And on America's Got Talent, how they have all these magicians now that are, doing the coolest things, the craziest things. I just can't figure out how they do it. But if you can take that dime and put it in your right pocket, and it automatically guarantees to create $1 from that dime, and when you need it most. That's the kind of leverage we're talking about. And so you need to transfer some assets today from and put it in that 10 cents in that pocket, and you have to put it in your pocket, in your left pocket. And then eventually it gets transferred to your right pocket for $1. So that's the leverage you create. Okay, so what are the options today? Well, we've already talked about the first option, which is Medicaid. And actually, Medicare will take care of us for the first 100 days. And I've had experience with my brother-in-law. At 100 days, they boot you. So that's not long-term care. That's a short-term care situation. And when they boot you, you can get on Medicaid, but you have to be in a spend-down provision. Todd, do you want to talk about that a little bit more?
Oh, sure. So to qualify for Medicaid, you have to be totally broke. We're talking $2,000 of assets. You can keep your house, but you've got to be really, really poor, and we can give you some more details on what that is. But hopefully, that's not your game plan to qualify for Medicaid.
Right. And then, as Terry Savage says in a recent article, she says, even if you did qualify for Medicaid, you're going to be shoved into facilities with other Medicaid recipients, and those are the folks that are below that poverty level that we talked about earlier, and that's not really where we want to go. That's not where we want to be. We don't want to live out our last days there. And we don't want our family members to do that either. So the other option then has been, since the mid-'80s, to get a standalone long-term care policy. The problem with those plans, though, is that they're very expensive, and they are use-it-or-lose-it propositions. They're difficult to qualify for today, very difficult. In fact, only 25%, and premiums can and do increase 130% with one carrier last year alone. So those that are on fixed income, if you have an increase of 130% from what you thought you were going to be paying less, that's huge impact. And I like this statistic the most. In 2000, 700,000 policies were sold on the standalone. So that was the product of choice at that time. Last year, only 60,000. So there still are people that are getting standalone, and that's fine. And we have those, and if a client insists that they get the standalone, we will do that. We'll comply. But you can see that is not the direction the country is going in. They're going into the leveraged care concepts that we're going to be talking about here further. The key to that is that standalone really is not where the direction we're going in. The other option would be just to be rich and pay for everything or self-fund. And we see a lot of clients that will do that, or at least come to us and say they'll do that. But even the wealthiest clients that we have, literally the multi-millionaires, the billionaires, they will set up these long-term care plans primarily because they understand the concept of leverage. And leverage is really the key. Why not take the dime and create a dollar? They were doing that. They've been doing that their whole life in real estate acquisitions. They don't use their own money for real estate acquisitions. They use somebody else's money. And so, it's the idea of leverage. And then we think that the ideal situation is to reposition some of those assets, some of your assets, into the leveraged care solution. Reposition some of it. So let's spend some time now talking about the new leveraged care solutions and the options. Todd, can you talk a little bit about this?
Yeah, so we've been doing this for quite some time and researched lots of different plans and seen how they work when they go to payout. We found that this leveraged care options are the best. They also call them hybrid long-term care.
There's asset-based
care. And so we have a lot of experience working with these and found that they're great solutions. There's quite a few versions of them out there, and we're singled out just one type that we're going to talk about today that we think is, for long-term care purposes, the best out there.
And we will disclose which one's the best here shortly. So hang on to that, because we will tell you which one is the best. But the idea is you can take $1, as I said, to grow to $3 immediately, and it can grow as high as $10. So, and I think probably the best part of all of this, if you dodge the long-term care bullet, so you don't experience, and you're part of that 20% of women that don't use long-term care, or the 40% of men that don't use long-term care or don't need it, and you pass away, either there's an insurance benefit that passes to your beneficiaries or an account balance that does. So it's a return of premium of what you put in and return of investment to someone. So it's not a use it or lose it proposition. So what are the trigger mechanisms for the leveraged care solutions, Todd?
Yeah, so the first one, that probably one of the most common, is cognitive impairment. I know it's most of our biggest fear is that we're going to lose our marbles in the last stages of life, but it does happen. We've all experienced people that have had Alzheimer's or some kind of cognitive impairment. That's one trigger. The other is going to be you can't do 2 of the 6 activities of daily living. And you're probably familiar with that, but this is how most insurance companies, long-term care insurance companies, trigger, is if you can't do 2 of the 6, which is eating, bathing, dressing, toileting, transferring, and maintaining continence. So if you can't do 2 of those things, or you have cognitive impairment, that would trigger. You'll get there's a note from your doctor, that there's a form that they're going to complete that says, yep, indeed, he cannot do 2 of the 6 activities. So
And so all leverage care solution plans options have that. And so what are the leverage care solution options, Todd?
All right, so the first one is long-term care annuity. We find these are really good if you have an old annuity that's had some growth. Maybe you've got a Vanguard variable annuity that you're wanting to 1035 exchange. You can do that. The IRS passed a law in 2006 that, from the Pension Protection Act, went into effect 2010, that you can convert a long-term care annuity, even no matter how much gain there is, if it's non-qualified, into a new long-term care annuity that's has to be a qualified long-term care annuity, and those benefits can be received to you tax-free. So if you do have an old annuity that you're not sure what to do with, this is a great play We've got lots of options. I'll be happy, your dad and I will be happy to go over them with you.
Okay, the next one is the life legacy, and this is in situations where you want to have some extra life insurance. This is actually the plan that we set up for my wife. We wanted some extra life insurance for our grandkids, specifically for our grandkids, not for our kids, but for our grandkids. And so we have that there, and it has a long-term care benefit attached to it that extracts, or the long-term care benefit comes from the life insurance policy. And these have been around for a while. Now, both of these plans, the annuity and the leverage care, the life legacy plan, some of our clients have these already in place, and God bless you. And it's awesome that you have that. You've taken an affirmative step and you have something in place. But the question today is, which of all the plans, Leverage Care Solutions, offers the greatest leverage for care?
For care, yeah.
That's what we're talking about. We want to focus on the number one plan. And so what is that, Todd?
All right. So, yeah, that's going to be this return of premium long-term care, and we're going to go over more reasons why. But so the life legacy care is going to be great, but it's going to have a little more of a component for life insurance than just long-term care. The LTC Life, the return of premium long-term care, is going to be focused primarily on long-term care. You will get a return of premium. We're going to get into the more specifics here. You'll get your money back, or you'll get it back at death. It's not going to leverage or buy a lot of life insurance, but it's going to be fantastic, the best there is, for long-term care.
Perfect. Okay. Well, let's get into specifics then. So, with the return of premium long-term care plan, you're going to take a dime, as I said, and create the dollar. You can choose a 48-month benefit or up to an 84-month benefit. Most of our clients are around the 72-month or 6-year benefit. We seem that seems to be the perfect position for most everybody. It also creates an immediate life insurance benefit, so that if you put in X amount, 100,000 or whatever, and you pass away, your family gets at least that money back, but sometimes more than that if you were to pass away. If after 5 years you say, well, you know, I've decided I'm going to go another route. I don't want to do this. I'm going to move to Thailand, and they're going to be taken care of there. And I don't really want to do this plan anymore. You get a full return of your money if you want it back. So that's kind of an
yeah. I mean, that's, after year 6, 100% of your money is available. So if you put down $100,000 today, and after the 5th year, the first day of the 6th year, you could get 100% of your money that you put in back. And
frankly, I don't know why anybody would do that, though. You know, once you're in,
yeah.
but you could. So because this also does pay foreign benefits as well,
right.
So in foreign countries. So and then it also, this particular plan has an inflation benefit option, which to me is lights out, because I think that's one of our biggest concerns is inflation, what it's going to do, and how our needs are going to grow, and for medical coverage. It's just going to get bigger and bigger and bigger, more expensive. And so to have that inflation option is important. No medical exam is required. It's an interview that you do to qualify. It's a little harder to qualify for this return of premium, this Rolls Royce of the leverage care solution plans than it is for some of the others. But we're at a very high percentage of qualification of those that submit. You can't call us the day after you've been diagnosed with Parkinson's and say, I'm ready to do this. Okay, you've got to do this so there are some requirements physically and age-wise. By the way, it's age 75 for this plan. Some of our other plans will take you
all the way to 85.
All the way to 85. So, right. Okay. Now we're going to talk more about the indemnity payout, Todd. But you want to just touch this real quick because we have a whole slide on indemnity.
The bottom line with indemnity is, well, most plans, indemnity, no receipts are required, but the biggest thing is you're going to get the full amount of benefits to spend how you want. So if your monthly benefit is $5,000, they're going to pay you the $5,000, even if you only had $1,000 of expense. So that's nice because you can put that other $4,000 or whatever's left over to go to other purposes, like having your grandkids come over and bake cookies or whatever you can think of. You have that extra cash to spend how you want. And we found that with our clients, it really resonates and is a lot easier for the claims process than having to submit receipt and having them reimbursed. But we'll get into that a little more.
You know, one of the things too, like in our situation with my wife's parents, you know, the kids, Jane and Karen, would go up and help take care of the family, you know, the family members there up there, the mother-in-law and father-in-law, and they'd fly up there. Well, you can use this money for airfare, for, you know, transporting your kids back and forth to help take care of you, and they don't have to be professional caregivers. So that's kind of key for the indemnity payout. So, okay. The benefits that you receive are 100% tax-free, income tax-free. So this money comes to you income tax-free, and it's not, you don't get a 1099 for it. It's money that just comes to you, and you do what you want with it. You don't have to give any to the IRS.
Right.
And probably the coolest part right now is the multi-deposit option. We're finding this extremely important for those that have money in IRAs. And we'll talk a little bit more about that here in a second. But that is an option. It used to be, when this plan first came out, with this Rolls-Royce plan that came out a couple of years ago, about a year and a half ago, 2 years ago, was that you had to have a single deposit. Now you can use multiple deposits to get to where you want to go. So let's talk about, give you an example of how this new plan will work. This Rolls-Royce of the leveraged care solutions, the return of premium long-term care plan, how it works. So Todd, you want to take it away on these numbers here?
Yeah, sure. So we'll start with the male age 60 without inflation. Initially, it's going to be $481,000 with a total care pool $6,688 for 72 months. What we're finding is the best value, typically, or most common or popular from our clients, is going to be the compound inflation, especially for men. That works really well. The numbers are really significant. So they're going to get a 5%. If you chose the 5% inflation option, it's going to start out lower. Instead of the 481, it's going to start out at 323, but it's going to inflate at 5%. So by the time our 60-year-old is 85, he's going to have $1.1 million
in the pool
in total benefits available at $13,405. And we'll give you your own specialized. We'll talk about this more so you can see your own illustrations. Everyone's going to be different, but that we do like, especially on men, the 5% compound seems to be the best value.
Now, and one thing too that we need to point out right here: everything you see on this screen is guaranteed. There's no market trends. There's no index. This is 100% locked in and guaranteed, and everything is a mathematical calculation. So if you took the 481, which was the pool, the 323. And you take that initial pool and you multiply that out 5% compound over 25 years when you're 85 years old, it'll be $1,100,000. That is all locked in and guaranteed. Okay.
Right, yeah, like most long-term care, traditional care, where they can inflate it, like Dad said, 130% or 50%.
Well, they can increase the premiums, yeah.
Increase the premiums. There's no changing there's no other moving parts. That's what's really nice. It's guaranteed for the life of the contract.
Okay, good. Well, let's look at another example. This is the multi-deposit option. So I don't have $100,000, David, or I don't want to part with. And frankly, we need to think outside the box for our care. The statistics are telling us that we're going to have care. We're going to need care. We're going to require care. So we need to think outside the box. And we kind of need to be a little bit more bold. I know a lot of us don't want to part from our brokerage account money. But, you know, you can't have it all. It shouldn't have it all in risk anyway. And some of you have CDs or you have money market accounts. You have some passive money. That's a no-brainer. But you need to be thinking outside the box. But in this case, the client calls us and they said, hey, we've got a house, we've got $100,000 in a brokerage account, and we have $3 million in an IRA. Okay, and if we take the money out of the IRA, if we take $100,000, we're going to have to expose all that to taxes. And that may be fine for some of you, especially if you're trying to play the tax bracket management, trying to stay as a couple under $320,000. You know, the key is really that you can also do this multi-deposit option. And in this case, let's say I wanted $100,000. My example is $100,000. So we're going to show you what the benefits would be for $100,000. But then you could also deposit $17,000 a year for 7 years.
Right. There's a 5, 7, 10, and 15-year option. The key with that is you can't go beyond 75 in funding. So
70 is your last.
Yeah, 70-year-old could do 5 years.
Yeah, that's it. But here's the point though. You would put in $17,436 for the seven years, which is a total of $122,000. And let's see what kind of benefits that we get here, Todd, for that $122 versus $100,000 single. So you get this is a female 60 getting a 3% inflation with a 6-year benefit, 72-month benefit, and the initial pool is $375. So that's day one. So she took that $100,000 and created $375. That's 3.75 increase on your appreciation. But what is that on the $17,000? If you put the $17,000, the internal rate of return is astronomical, and we'll show you that here in a second. But in 20 years, that benefit, because we did the 3% inflation on this, that 20-year benefit now grows to $659,000, or translated tax-free to $8,490 a month for the 72 months. So that's pretty significant, and you're basically taking care of the long-term care situation, and you're putting in $17,000 a year instead of a single deposit. That's the point. Okay, and it's a cool option to have. Perfect. Okay. Now, Todd, talk about the return on investment. That's, you know, we have a lot of CPAs that are clients. We have a lot of engineers that are clients, a lot of engineers, and they're very, I guess the word is retentive. They want to know, okay, well, what if I took that $100,000 and I put it into the market? Now, remember, to compare to this, it has to be guaranteed, though. It has to be a guaranteed investment because this is all guaranteed. So you can't have any market risk at all. But if I were to take the $100,000 and I'm 60 years old and I were to put that into some other investment, what kind of return would I need after tax to equal the return that I'm going to get here? Right.
And the internal rate of return, if you're not familiar with that calculation, it's a great formula for comparing any financial any investment, whether it's real estate or whatever you can think of. I'm putting in money, and then I'm going to get a return on that investment over time. That's what internal rate of return compares apples to apples, all the different returns. So in this case, if you were to trigger after the first year, you put in $100,000. Now, hopefully that's not going to happen. You're going to have a stroke right after you buy this, but let's say you do. You'd be making a 63% rate of return on investment. You'd need to have that elsewhere, and these are, again, after-tax dollars to get to this. If you triggered in year 10, so if you're a 60-year-old and you trigger at 70, you'd have to average 14.51% to equate the same kind of benefits or returns that you're getting from this return of premium long-term care. Year 20, your rates are going down a little because it's over time, but we're putting in $100,000 and you're getting $816,000 worth of benefits. And then
let me just say this too, and this is guaranteed. So you would have to pull down 10% after tax, so it's probably about 13-14% before tax, for the entire 20 years without ever having a loss in the other investment. And that's just not, there's nothing out there that you can do that.
Right. I just saw somebody texted, or I don't know how somebody sent a note, can you lose the investment? And the answer is no. It is guaranteed by the insurance company, which is has a 96 Comdex rating, A+ rated with AM Best, been around over 100 years. We'll get into that a little bit later. but it is 100%. I mean, it is guaranteed. It's even backed by your state insurance reserve funds as well. So it is guaranteed your principal. So you put in $100,000, that $100,000 is about as safe as anything there is. And so comparing that to other safe money investments, like maybe you want to buy a 10-year treasury. Well, that's great. You're going to make 1.67% return on investment. Compare that to 8.43% in 30 years for your care. Perhaps you won't need it, but you likely will. We've already got
and here's the point to the 10-year treasury, though. If I put $100,000 in the 10-year treasury and I need long-term care in the first year,
right?
How much do I have? I have $100,000 is all I have.
Plus 1%.
Yeah, plus 1.67%. Whereas here I have $323,000.
Right.
Okay, so it's the idea of the leverage. So. Okay, so what are my funding options? Where can I find the money? I love the Jerry Maguire where, he says, show me the money. Well, my question is, where is the money? Where do I have money that I can fund this with? This is a great idea, Dave. I think it's fabulous, Todd. We need to do this. So where do I find my money? Well, first of all, most of you hopefully have some cash somewhere around in a brokerage account or, in a CD or money market.
Yeah, ideally would be something like a CD, a low interest earning. Yeah, that would be nice if you had that. But a lot of people don't have the luxury of having $100,000.
Or they don't want it. They don't want a CD. They want everything at risk. And so you may have to pull some out of that. The other option is the multi-deposit option, again, and that would be from your IRA and your 401k and transfer some money out of that. And if you were to do that, most of our clients will do that over time, so they'll use the multi-deposit option. But some don't. Some use the single deposit option because you get more leverage, obviously, ultimate leverage. Now, what if I have an existing a guy called me the other day, says, I have an existing life insurance policy. And we see this a lot. And he says, my policy is has $100,000 of cash value in it.
Yeah.
And my death benefit's $110,000.
Right. Yeah.
So my net at risk carrier is $10,000. What good is that going to do them? And if they need care, they're going to be able to pull $100,000 out for their care, sure, of the cash value. Well, actually 90% of the cash value, so they'll be able to pull out $90,000 of it. Whereas if they did a tax-free 1035 exchange without any tax consequence at all, they'd be able to roll that in, and it would create a $300,000 minimum long-term care benefit immediately, and then it would inflate just like we talked about. So
yeah, look at your life insurance policies. Maybe you don't have the same need for the death benefit like you had, and you've got some good cash value built up. You could definitely 1035 exchange that into one of these. The other option, this is really neat, and we're seeing more of this lately, is the health savings account. You may not know it, but you can actually transfer this, which is completely tax-free, with your health savings account into this return of premium long-term care. Yeah, we're starting to see more and more. You probably won't have a huge amount, be able to cover the whole amount that you want to put down. So we're seeing a combo of maybe you have $30,000 in your HSA and you put the other $70,000 in with other cash or other investments.
Yeah, exactly. And then the other one is that with this new iteration of the return of premium long-term care Rolls-Royce plan, part of this is going into a premium for long-term care. Part of your deposit is, and that is deductible up to the maximum amount that the IRS will allow for your age group, and if you itemize.
Correct, and we can give you a tax guide if this is something you're interested in and you want to learn more about. That tells you the different rules and different amounts that you can have deducted. You can also, there's some neat things with business planning that we can do to get you some extra deductions as well.
Yep. Okay, so Todd, probably the biggest distinction between this plan, besides being fully guaranteed, I think that's probably the biggest distinction, is the fact that this is this Rolls-Royce plan is a cash indemnity payout. So what's the big deal?
Right. So, and I'm kind of the one that helps people go on claim once they're, if you were to buy one of our long-term care policy through us, probably go through me and I'll help get the claims going. And we have a lot of clients with reimbursement, and it works great for their family. It's not, not the end of the world to have reimbursement. Usually the care provider will then correspond with the insurance company, and so you don't have to be submitting receipts. But you only get reimbursed for what you have expenses for, and it has to be formal care. It has to be an RN or some kind of a formal facility that's taking care of you, and there is that reimbursement that's taking place, and you're only getting the amount that you had expense. If you had $5,000, like I said, coming, and you only had $1,000 of expense, you're just going to get $1,000 reimbursed. So ideally, if we could choose anything, we're going to want indemnity. So indemnity is you're just going to get the cash to spend how you want. I guess probably the biggest thing or the biggest benefit we're seeing of indemnity is that you can use the benefits to pay for informal care. So most of the time, you think about people that you know that have been on claim for long-term care, needed long-term care, it's putting a lot of weight, like Dad said, stress on the family, and you can use the cash from your policy to pay family members and friends. That's probably the biggest benefit of this whole plan, and what I see is that being able to use it for informal purposes, just family members and friends to be the care providers. And no receipts required. And some indemnity do require a receipt. This one does not. Go ahead.
Okay, so again, if we look at our total financial view and we say, okay, now what do I have? Where can I find the money to do this? If you just take a portion of your assets, and remember, this is an asset on your balance sheet. That's why they call it asset-based care plan, because it's still an asset on your balance sheet. It's not gone. It's not an expenditure like car insurance or homeowner's insurance or going to the movie. This is an asset on your balance sheet. It is something that will still be there, and if you ever decided, hey, I'm done, you can get your money back. Your kids get the money back if you never use it in the form of a life insurance benefit, or you get it back in the form of a long-term care claim that is leveraged. It takes $1 and creates the $10, as I said before. So now there are 4 basic guarantees for the return of premium long-term care plan. So Todd, talk about those 4 guarantees.
Yeah, when you get your illustration, your kit, you'll see these, and we'll go over these with you. But you have the guarantee for the long-term care benefit, and that's if you have an inflation option, that'll be guaranteed to inflate at whatever option you choose. Like Dad said, you have the life insurance benefit that's guaranteed. In some cases, especially with younger clients, we're seeing that to be a lot more than what your principal is. As you get older, it's pretty much just going to be the return of your premium in most cases.
To your beneficiaries.
To your beneficiaries. We have the reduced paid up benefit, which is going to be if you're
doing the multiple deposit option, and you get into it. Let's say you signed up for the 10-year multiple deposit option, and 5 years into it, you go, I need to use my money for something else. You can get a reduced benefit instead of the benefit that you had signed up for.
Right. Maybe you were going for it, planning on putting up to get the $100,000 worth, but maybe you only put in $80,000. Well, you'll get 80% of what you set out to get. Return of premium, again, you get your money back if you want after the 6th year. There is a declining surrender charge the first 5 years, but by the beginning of the 6th year, 100% of your money is available.
Right. Now, the key to any leverage care solution, any of them, is that you have to be healthy going in, and obviously that includes standalone long-term care policies, and they're a little bit more difficult. They're the most difficult of all to obtain today. The standalones are. This one it's certainly a lot more easy than that, but you do have to be healthy. So our suggestion to you is, no matter what your age, if you are under the 75 years old, for this particular plan, for the Rolls-Royce plan, you need to try to get it now, to get qualified now. And you know what? It doesn't cost any money for you to find out if you can qualify. It costs a little bit of time. Time is money. I understand that. But that's really all it costs you to see if you can qualify. And so one of the things you're going to want to do is get with us, and we're gonna help you. We're gonna help you decide exactly who this is for. So it's not on there. Oh, there it is.
There it is.
Okay. Go ahead.
Yeah. So we have a lot of clients that call us for long-term care, and this is a great one. Like we said, in most cases, it's usually the best option out there, but it might not be. So call us and we'll do a full long-term care evaluation for you and give you different options. There is traditional care. We find that traditional care, a lot of times, the standalone works for people with assets that are in the $500,000 and maybe $600,000 range. They just need it for that long-term care event, and they don't have other assets available. Maybe they have a pension or other things that you're getting income from. So we could look at traditional care. But for the most part, if you have the money available, you're going to want to do an asset care version.
Or leverage care, yeah.
Yeah, leverage care. And this one is really good because you're getting the long-term care, but maybe you can't qualify for this one. Some of them are a little easier to qualify for, and that's kind of where the art of what we do comes into play, is finding which one's gonna match you the best, because maybe your health, something in your health background is not going to let you get this one, so we look at some other plans. We have over 50 different plans to choose from. This is just one that we've singled out as probably our favorite and the best if everything lines up. So you have to be in good health. We've had clients that have said they want to get it, and then they kind of put it off for a while, and then they've had some health issues. I have several stories I could share where something changed in their health, and then they couldn't qualify anymore, and they wish they could have bought it. Sadly, it's happened several times.
So there's a special report that we have that we're going to make available to you, and you'll all get that link today. All of you will get that link today on that special report on the return of premium long-term care plan. I sent that to a gentleman the other day, and it does say in the report what the age limitation is, up to 75, but he calls me and he goes, I really want to do this plan. And I go, okay, well, how old are you? And he says, well, I'm 93 and my wife is 92. No plans available to a 93 and 92-year-old, so you missed that boat, and frankly, it wasn't even available to him at that time. So make sure you get it while you're able. And
if you are older than 75, and maybe you are the 92-year-old listening, tell your children, your other family members, that it might be applicable to. We found that happens a lot too. Yeah. They still need it as well. It happens, and I know we focus on those that we were working with some clients, and the husband has Parkinson's, and we were talking about getting the plan for him. We never did it, and now we're putting it on his wife, and so we're grateful that we're able to get to that. But we were so concerned on him, and sometimes you just forget. This is something you have to plan for. You have to do it in advance while you're healthy. So it's a great diversification tool for your financial plan. It's going to diversify. You have that guarantee, so it's not going to go down. It's your absolute return investment. You're not going to lose this money.
The IRR is great.
The IRR, and if you do need it, you've got some fantastic leverage, and it's tax-free. So you're not playing the market with this money. This is a different asset class, so that's why we put it as great diversification tool. And then again, a great return on investment. If you do need care, you're leveraging your money significantly if you do. Okay.
So the big $24,000 question is, well, why should I work with you, David? Why should I work with you, Todd, in your firm and the estate planning specialist? Well, and there are others that are offering plans that are similar to this. We understand and we know which of the Rolls-Royce plans is the best Rolls-Royce. We know. We have availability in virtually every state to help you in this. But frankly, we put our pants on the same way that everybody else does. And there are others that are qualified to help you. But I can honestly tell you that of all the people that are out there, your stockbroker, your banker, your neighbor down the street, they may be qualified, but they certainly are not recommended by Mark Skousen, by David Eifrig, by Bob Carlson. They're not contributing editors to Weiss Education, and not recommended by Sagami and Money Markets. And we have that. We have been and continue to be recommended by these top gurus, financial gurus, that people spend thousands of dollars to find out information on how to better invest their money and they continue to recommend us and have recommended this plan to their subscribers.
Yeah, we are their experts. We are the experts when it comes to long-term care. We've been doing this. Dad's been doing it for 30 years. But as far as the asset-based care, we've been doing it. We've been pioneers in this industry, offering since 2007 different versions of these asset-based policies or leverage care. And so we have a lot of experience. We can tell you the pros and cons, kind of the pitfalls and things that we've experienced, what the advantages are to the various types of plans, and we can lay those out for you. I saw a question. Somebody said, well, what happens if I don't have more than $500,000 in assets? That's a good question. If you have a pension or other retirement sources, we don't want you to be putting your money into this and be broke. You still need your assets to live off. You're going to need some kind of income. So we want to make sure that part of your equation, your financial planning equation, is solved, that you have enough income, and then this is the next place, so that we're not going to burn through the other assets to pay for your care. But if you're already at maybe $100,000 range or $200,000 range, and you're going to be needing every last drop of that money, you're not going to want to put $100,000 into this. You'll probably be on Medicaid anyway. So, but for those that this is for somebody that has a fair bit of assets that they've saved, and they want to protect that and leverage the dollars for their care, so they can keep what they have safe, and then maybe send that to your beneficiaries or other asset classes. Go ahead. Okay.
So I guess I love Rick Durfee. He's our estate planning attorney that we recommend, and he always, at the end of his presentation, always asks, so what? Well, I'm going to ask what to do next. What should you do next? What's the next step? I think this might apply to me, so what should I do next? So let me just give you the next step here. Is I would recommend that you can wait for the email that we're going to be sending to you as a follow-up to this, that Alyssa will be sending to you right after this presentation. She'll be sending you an email, and it'll have on there this return of premium long-term care analysis request form. And from this form, we can actually pivot to the other directions, but we're going to show you what this Rolls-Royce plan looks like. And guess what? We're going to actually reveal to you in that what the name of the carrier is, because I can't tell you that right now, but I can certainly tell you that offline, and I will tell you, and we will tell you who it is. As Todd said, though, it's an A-plus carrier with a 96 Comdex out of 100. I mean, this is an amazing carrier, very, very solid, and we have compared all of the plans that are similar to this.
Right. And
right out of the gate, it's 25% better, and pretty much across the board. They've already done the repricing with the new CSO table, so some of the carriers are actually having a rate increase, and this plan is solid. It's there. I'm not going to have a rate increase, at least right now. So we need to get into it now, because once you're in, you're guaranteed, locked in. Even if they increase the premiums next year, that doesn't phase you. That won't phase you. That'll be for the people that waited, that didn't act on what we told them to do.
We're seeing the competition of this plan, particular one. We might see a reimbursement that has the same benefits side by side, but this one has indemnity, and it's on par with their same benefits that are reimbursement. So that's why
So you're going to want to fill out this form. It's a fillable form. You'll be able to fill it out. Alyssa's going to send it to you today, or you can call us. And here's the phone number. We've had the phone number up the whole time. This is our toll-free number. Most of you have called us before, or you wouldn't even be on our list. And there's our website. You can go on there. There also is a video that you can watch that I did. What was it about?
Mickey Mantle.
Yeah, it was Mickey Mantle. We call it the Mickey Mantle leverage video, but it's on the website as well. It's about a 20-minute video, kind of a recap of the return of premium.
Yeah, it'll be reviewing.
Great. Okay. Well, listen. If you have any specific questions, get on the phone. Call us. We're here today. We have blocked off most of the day today to talk to you. We also have staff that can help you. We have other representatives that can help you. So If you want to chat, give us a call today. Maybe you have a specific question that you might have.
Yeah, we thought several questions. Unfortunately, we couldn't get to them. But yeah, we definitely can be happy to help you get as detailed as you want to go.
Great. Well, thank you for participating today. There was a lot of folks on the call. You're certainly not alone in this quest, and we would like to help you. And have a great day, all of you. Thank you.
Thanks.